In this session, we are going to learn accounting cycle. What do you mean by accounting cycle? The accounting cycle is the name given to the collective process of recording and processing of accounting events of a company. The series of steps begin when a transaction occurs and end with its enclosure in the financial statements. Let's understand each step in detail. To start with financial transaction, it needs to be recorded based on double entry system. What do you mean by double entry system? Double entry bookkeeping is a system of bookkeeping of every entry to an account requires a corresponding and opposite entry to a different account. Transactions are recorded in terms of debits and credit. Every business transactions will involve two accounts. For example, when a company borrows money from its bank, the company's cash account will increase and its liability loans payable will increase. The sum of all debits is equal to sum of all credits. Double entry transactions are posted in two columns with the debit posting on the left and credit entries on the right, and the total of all debit and credit entries must balance. The second step of accounting cycle is journalizing. What do you mean by journal? The journal is the point of entry of every business transaction into the accounting system. It is a chronological record of the transactions showing an explanation of each transactions, the accounts affected, whether those accounts are increased or decreased, and by what amount. This is the format of journal: date, particular, LF, debit and credit. The third step of accounting is ledger posting. What do you mean by ledger posting? The process of transferring the journal entries into the ledger accounts is known as posting. Every transaction flows from a journal to one or more ledgers. It is a collection of an entire group of similar accounts in double entry bookkeeping. This is the format of ledger posting. After journalizing the transaction, we should post into the ledger cash account, debit side and credit side, date, particular, LF and amount, and in credit side also date, particular, LF and amount. The fourth step of accounting cycle is transferring ledger balance to trial balance. What do you mean by trial balance? Trial balance is the list of closing balances of ledger accounts on a certain date and is the first step towards the preparation of financial statements. This is the format of trial balance: serial number, particulars, LF, debit and credit. What is the purpose of trial balance? It ensures that for every debit entry recorded, a corresponding credit entry has been recorded in the books in accordance with the double entry concept of accounting. Next, it ensures that the account balances are accurately extracted from accounting ledgers. It assists in the identification and rectification of errors. Accountants use it as a basis while preparing financial statements. The two important financial statements are profit and loss account and balance sheet. What is profit and loss account? It is the statement that reports the company's financial performance in terms of net profit or loss over a specified period of time. As we all know, the net profit or net loss is determined by the income earned over expenses incurred. So let us now understand what we mean by the terms income and expenses. What is income? The amount of money or its equivalent received during a period of time in exchange for labor or services from the sale of goods or property or as profit from financial investments. In income, there are two types of incomes: direct income and indirect income. What is direct income? Direct income is one which is earned directly from business activities and which are regular during the course of business. These are the examples for direct income, sales, discount received, cash incentives, and rebate. What is indirect income? Incomes that are not regular in nature and are not directly related to the business activities. And these are the examples for indirect income: interest on deposits, sale of assets, miscellaneous income, and sale of scrap. Next, what do you mean by expense? Money spent or cost incurred in an organization's effort to generate revenue, representing the cost of doing business. Types of expenses: direct expense and indirect expense. What is direct expense? Expenses connected with purchase of goods or manufacturing of finished goods, having an impact on margin and selling price of the product. These are the examples for direct expense: purchases, freight, insurance, power charges, and wages. What is indirect expense? Expenses other than direct expenses are known as indirect expenses. These don't have direct bearing on trading or manufacturing activities. These are the examples for indirect expense: office rent, salaries, conveyance, printing and stationery, and communication. Representation of profit and loss account. This is a format of representing the profit and loss account. Next, we are going to understand what is balance sheet. Balance sheet is a statement prepared to measure the exact financial position of a business on a particular date. Liability is referred to as an obligation or debts payable by the enterprises in future in the form of money or goods. To start any business, you need to invest certain amount, that is called as investment. So, if you take a loan from bank, it is also called as liability. What do you mean by current liabilities? Any outstanding amount payable is treated as a liability for a business. For example, any outstanding expense like office rent, loans payable, amount payable to your suppliers, taxes like VAT, TDS payable to tax departments, or loan taken from any party. These are the current liabilities: short term debts, trade payables, taxes due, accrued expense. Next, what is asset? Asset is something that is acquired or purchased and owned, regarded as having value and available to meet debts, commitments, or legacies. There are two types of assets: fixed assets and current assets. What is fixed assets? Purchased for long term use and are not likely to be converted quickly into cash. These are the fixed assets: land, machinery, and building. What is current assets? That is either cash, a cash equivalent, or which can be converted into cash within 1 year. And these are the current assets: cash, bank balances, investments and deposits, inventory. Representation of balance sheet. This is the format of representing the balance sheet: liabilities on credit side and assets on debit side. Next, what is the purpose of financial statements? Estimate the ability of business to generate cash and its uses and sources. Estimate whether a business can pay back its debts. Track financial results on a trend line to spot looming profitability issues. Derive financial ratios indicating condition of the business. Investigate certain business transactions as outlined in statement disclosure, used by banks and lending companies to decide whether to grant a fresh working capital, extend debt securities for the purpose of business expansion, or any other expenditures. Thank you.